option traders. For today's trade, we're looking at a calendar spread in major streaming service Netflix. So taking a look on MarketSmith, shares have been having a strong rally since July of 2022. The stock retook its 50-day line near the end of July in strong volume on a solid earnings report. Then Netflix went on to form its first successful base in quite a while. Another strong earnings report led to the stock breaking out and continuing the move higher. Shares have maintained support at the 50-day moving average as well. The stock's relative strength line is near recent highs and showing improvement amid the recent run higher. Also, the industry group has been improving and now ranks number 9 out of IBD's 197 groups. So for today's trade in Netflix, we're looking at a calendar spread. And a calendar spread is an income trade that involves selling a short-term option and buying a longer-term option with the same strike price. Calendar spreads are also known as time spreads because they use the same underlying asset and strike price, but different expiration dates. This is a relatively low-risk strategy that profits from the passage of time and/or an increase in implied volatility. Traders typically use call options unless the trade has a slightly bearish bias, in which case they would use puts. So let's take a look at my trading platform and set up a trade in Netflix. So looking at Netflix here, with the stock trading around $3.56 a share, we are going to be looking at the $3.60 strike price for this trade. You're going to want to select calendar as your spread type if you're using Thinkorswim. And as for the expiration date, you'll notice a change. For calendar spreads, they are split expiration dates. And you're going to want to choose, this one works, the February 17th, February 24th, and then we will change this one down below. And we're going to be looking at this side of the screen, which has the prices for put options. So right here, we're going to adjust this expiration date to be March 17th. And to recap this trade, we are looking to buy one March 17th expiring 360 put and sell one February 17th expiring 360 put. With Netflix stock trading around 360, setting up a calendar spread at 360 gives the trade a neutral outlook. We're looking at selling the February 17th 360 strike put option and buying the March 17th 360 strike put, and that'll cost around $2,120. So notice that the spread here is not between two different strike prices, but rather two different expiration dates. That results in a net cost for the trade of $730, and this coincides with the most that the trade can lose. The estimated maximum profit here is $850, but that could vary depending on changes in implied volatility. The idea here is that if Netflix remains around 360 for the next few weeks, the sold option will decay at a faster rate than the bought option, allowing the trade to be closed for a profit. The break-even prices for the trade are estimated at around $340 and $385, but these can also change slightly depending on the impact of changes in implied volatility. As for trade management, this is important, I would set a profit target of 20% and I would set a stop loss if Netflix stock breaks through either 340 or 385. Remember that calendar spreads are considered a more advanced strategy and not recommended for beginners. And as always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases. And be sure to join us here every day for our regular options content where we discuss new trade ideas.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.